Hi, today we discuss about the international finance. International finance is the branch of economics that studies the dynamic for foreign exchange, foreign direct investment, and how this affects international trades. Also studies the international projects, international investments, and the international capital flow. International finance can be broadly defined as the study of the financial decisions taken by a multinational corporation in the area of international business, that is, global corporate finance. International finance draws much of its background from the preliminary studies in the topics of corporate finance, such as capital budgeting, portfolio theory, and cost of capital, but now viewed in the international dimension. Now we discuss about the understanding the role and impact of green bonds on the financial sector. So socially responsible investment has become an important role of financial services in the world. One of the latest investments that are available in the market is called green bonds. Its popularity has taken off the recent years. A green bond is a bond specifically earmarked to the use for environmental and climate activities, meaning green bonds are used to fund projects with clear environmental benefits. To elaborate, green bonds are intended to encourage climate friendly projects that aimed at pollution control, sustainable agriculture and waste water management system, clean transportation, climate change, adaptation, etc. Green bond market is open to different types of issues such as government bodies, corporate and financial institution. Now we discuss about the revenue management, meaning of its and benefit, scope and future of revenue management. So the phenomena of revenue management gained important in recent years due to variable and discriminatory pricing schemes offered by various companies to their customers. Revenue management applies the orderly analytics that predict the behavior of the consumer at micro level and augment the prices and availability of products to the customers, thus enhancing the overall revenue for the company. The aim of devising revenue management techniques is to deliver the fine product or services to the appropriate customer at the precise prices. Revenue management system is based on the analyzing the customer perception of the value that the product would provide and make straight the availability, placement and price according to that perception. Now we discuss about the mortgage loan, meaning of mortgage loan, type of mortgage loan and approval factors of mortgage loan. So mortgage loan is a loan secured used to finance. So mortgage loan is a loan secured used to finance by real properties, and it is usually used with specified payment, period and investment rates according to the agreement of the mortgage loan made between the two parties. Mortgage loan also can known as mortgaged loan. Under legal agreement, the mortgagee borrower gives the mortgage lender and lines on the real assets as collateral for the loan. However, the home loan and mortgage loan are often used interchangeably. So the mortgage is really an agreement that makes the home loan work. The commercial bank would not lend you some hundreds of thousands of money unless asset securitizations, meaning of securitization of asset, process, parties involved and benefits. So asset securitization is a way of financing for lenders to obtain funds in the capital markets for the organizations of consumer and business loans. It is different from the traditional way of financing where lender finance loan organizations with deposits. Started in 1970, the asset securitizations market had a remarkable history of growth and development. By 2000, it's become the largest sector of the US fixed income securities market. It matured capital market assets securitizations have proven to be an efficient way of financing in that it reduces the ultimate funding cost for the borrower, improves the financial operations for the lender. So now we discuss about the convergence of accounting standard. So the emergence of the accounting standards has been beneficial for the companies and the investors of the companies. The accounting standards help in presentation of the financial information of the company. The companies are interested in the performance of the company and financial results are referred to analyze the results. Therefore, the companies must be able to communicate information that is useful for the investors and the other related parties. The emergence of the standards has been helpful in reducing in uniformity of the presentation in the companies. So now we discuss about the comparison between merit-based regulations and disclosure-based regulation. So there are two basic models of regulatory systems, which is the supervision framework for securities market, which is a merit-based regulation, and disclosure-based regulation. These regulation systems are important to provide adequate investor protection and regulate business practices or codes of conduct that reduce systematic risk. Now we discuss about the merit-based regulation, MBR. The definition of merit-based regulation: a securities regulator is needed which all matters relating to securities and to take all responsible measures to preserve the confidence of investors in the securities market by ensuring sufficient security for the such investors. The securities regulators has the discussion to approve the proposals with such revisions and subject to such terms and conditions as it deems it. So now we discuss about the international finance is the importance perspectives of asset and securitizations. So asset securitizations is the transformations of a mix of liquid individuals loans that are combined into relatively similar pools and transform into highly liquid bonds traded in securities markets. And usually when securities are backed by non-mortgage loan, so they are referred to a asset backed securities, that is ABS, asset backed securities, as I told it. And securities issued exclusively against credit and loans with mortgage guarantees are referred to as mortgage backed securities, that is MBS. Assets like ABS and MBS, and it takes now widely spread to fixed income portfolios at both the institutional and individual investors level. Although the target and most well-known example of asset securitizations is the residential mortgage market. So now we discuss about the role of asset securitizations in financial crisis. The financial crisis showed its first sign in the first quarter of 2006 when the housing market returned. the number of subprime mortgage that were designed with a high interest payment so began to default. Many of the loans were highly risky and only possible due to the clever creation of products like 2 by 228 and 3 by 227. Adjustable rate mortgage ARMS, there's loans offered a fixed rate for the first 2 and 3 years, and then adjustable rates for the remaining 28 or 27 years. Respectively, after the first 2 or 3 years, the adjustment of rates would be substantial enough as to be unaffordable for the subprime borrowers. Thus, the mortgage were designed to be refined. Now we discuss about the implications of asset securitizations. Implications of asset securitizations. Asset securitizations can be defined as the partial or complete segregations of a specific set of cash flows from a corporation's other assets and the issuance of securities based on this cash flow, that is, exchanging one asset for another. The types of financial assets involves in asset securitizations. So transactions are often receivable. The practice of securitizations originated with the sales of securities backed by residential mortgages, but framework of the asset securitizations has rapidly expanded from its initial route of mortgages and receivable to the other for more variable cash flows. In home equity loan markets, commercial loan markets, credit card receivable, auto loans, and um, and flows home equity loans. So small business loans, corporate loans, state lottery winning and litigation settlements, payment and other type of loans. So now we discuss about the foreign currency swap or foreign exchange swap. So each equity has a different access and different needs in the international financial market. Companies received more affordable credit rating in their country of domicile then in the country in which they need to raise capital. Investors are likely to demand a lower return from a domestic company, which they are more familiar with than from a foreign company. In some cases, a company may be unable to raise capital in a certain currency. So, currency swap are also used to lower the risk of currency exposure or the exchange returns on investment into another more favorable currency. Therefore, currency swaps are used to exchange assets or capital in one currency for another for the purpose of financial management. So now we discuss about the effective communication in investor relations. So corporations worldwide work uh, daily to increase the value of their stock for the investing public in order to exploit this value. Business most constantly make every effort to extensively communicate to their investors and potential investors. In view of these investors, relations are a vital part of business strategy. So, principally in the area of communication, corporate departments involved with investors, directions must make a necessary connection between efficient communication and company goals. Since communication is starting to play such an important role in investor relations, corporate communications programs are being created not only to participate to finance areas but also to take part in media relations and other public communications. Now we discuss about the emerging trends in international capital market. So these interrelated development in global capital markets are the sustained rise in gross capital flows relative to net flows, the increasing importance of securitized form of capital flows and market, the growing concentration of financial institutions and financial markets. So, taken together, these trends may signal what some others have referred to as a quiet opening of the capital account of the balance of payments, which is resulting in the development, strengthening, and growing integration of domestic financial system within the international financial system. Finance is being rationalized across the national borders, resulting in a breakdown in many countries is the distinction between onshore and offshore finance. So that's for the video, my friends. And as I always said that if you like my videos, please like, comments, and subscribe my MBA channel. I need your support, my friends. Thanks a lot for your precious time. Okay.